شوف الكلب يهرب، الكلب يهرب. امريكي امريكي امريكي.
For countries in East Asia, except for Malaysia and Indonesia, everybody else is a net importer of oil. Overnight, crude oil soared by 20-30% to $110 per barrel, a level not seen since 2002. The reason was Israel attacked Iran's oil supplies. And that created a panic among investors. For countries in East Asia, except for Malaysia and Indonesia, everybody else is a net importer of oil. And that will create inflationary pressure, and also, of course, that will bring on economic damage, and certainly economic growth will slow and the inflation will pick up. And this is the worst case scenario we saw when the US and Israel started to attack Iran. And everything is getting out of control now.
I would say that the terms of trade, the cost of energy, and the potential volatility on the rupee side is what I think will worry the markets. If you are a foreign institutional investor, at this stage there is de-risking happening everywhere, and after the first phase of active de-risking, or I'd say in general de-risking, now they are starting to reward oil producers, penalize oil consumers. So from that, India stands to be on the losing side.
Unless the crude oil prices go back to $75, and unless the situation in West Asia is diffused and there is some kind of agreement, it is very difficult for the market to go up from here, because we may see in between some kind of technical rebounds, but undertone is bearish. See, the reason is that 70 to 75% our energy needs we import, and high energy prices has direct correlation with the GDP growth of our country. And if GDP growth is not what we have estimated, in that event and in that case, it has impact on the overall corporate India and corporate earnings and corporate top lines. And if they come down because of these inflationary energy prices, then certainly the markets will come down.
And I think the call there is that this is not just painful for India, it is actually painful for everyone, including the people who are involved in these battles. It is as much a problem for the West Asian oil producers whose oil is not able to come to the market, as it is for America, where there are midterm elections which are due later this year, and a number of the core support base of the American president actually have warned against these wars and getting involved in them. So it is reasonable to expect that this will be a short-lived war, that because it's not in China's interest, it's not in American interest. So this is the game of brinkmanship that will play out for a couple of weeks, maybe another 4-5 weeks, maybe 6 weeks. But it is, I think, a reasonable expectation that by end of April we see some kind of conclusion here, because stress is building up on both sides. And wars only continue till the time that one side can withstand it. This is not something that warrants. So again, it is the strategic call. I think the government and the RBI have to collectively decide what we are preparing for. Are we preparing for a 6-8 week conflict or a 1 year long conflict? If it's a 1 year long conflict, then I think monetary policy action is required. My base case is within 6 to 8 weeks, because remember, we are not the only country that is getting stressed by this. There are countries whose oil is not coming to the market, and this is like 80-90% of their incomes. So there is only so much that they can absorb in terms of pain. The country that is being bombarded also has its own limits on how long it can withstand it. The countries that are involved in this, who have started the war, also have a certain pain threshold for the level of oil price and how long it can last there.